In the modern world, we often delude ourselves into believing that human beings are fundamentally rational creatures, especially when it comes to money. We spend countless hours analyzing green and red candlestick charts, poring over dense financial reports, and treating the opinions of Wall Street elites as immutable truths. Yet the harsh reality is this: you are not controlling your money with your rational mind. You are being driven by the same primal impulses that governed human behavior in prehistoric times. FOMO, fear of missing out, is not merely a psychological state. It is a core survival code embedded in the operating system of the human species. But in the era of digital finance, this code has been hacked by the system itself. Imagine a herd of gazelles on the African savanna. If the entire herd suddenly bolts, the gazelle that pauses to analyze the situation will be the first to fall into the lion's jaws. In the past, following the crowd was a survival strategy. But on the financial chessboard of the 21st century, following the crowd is the fastest way into the slaughterhouse. The trap does not lie in stock prices or the value of cryptocurrencies. The trap lies in the gap between reality and perception. You don't buy an asset because it has intrinsic value, you buy it because you fear that tomorrow your neighbor will become richer while you remain stagnant. This is an invisible prison, its golden bars forged from hope and envy. Welcome to the flat world where we confront truths that society does not want you to see.
The machine that crushes latecomers.
To understand why FOMO is so dangerous, we must strip away the facade of the world's most powerful financial institutions in places like New York and London. The market is not a fair playing field. It is a highly stratified ecosystem with a clear food chain. At the top of the pyramid are the architects, major investment banks, hedge funds, and high-frequency trading algorithms capable of executing millions of transactions per second. They do not predict reality, they create it. For them, news is not information, it is a weapon. As the saying goes, the market always moves before the news. By the time you read a glowing headline about a miraculous rally in major US financial publications, the party is already over. Predators at the top bought in months earlier, when fear was rampant and uncertainty prevailed. When the news reaches enthusiastic newcomers driven by FOMO, they serve one purpose: liquidity for those exiting their positions. You are not an investor. In the eyes of the system, you are exit liquidity. Your excitement is the price they pay to realize their profits. When you see everyone flaunting gains, when you see explosive numbers on your phone screen, that is the signal that the machine is luring prey into the trap. Why do we fall for it so easily? Because Western media does not sell information, it sells emotion. Euphoria is a powerful drug. When the Nasdaq or S&P 500 hits a new high, financial news networks don't discuss risks or bubbles. They interview overnight millionaires. They create the illusion that anyone can get rich except you, the hesitant one. This is especially familiar to those in the crypto market. The greatest paradox of the information age is this: the more you know, the more likely you are to lose, because what you receive is not raw data, but curated data designed to shape your behavior. In investing, news is often the enemy of profit. A real opportunity is usually accompanied by ambiguity, doubt, and fear. By the time everything is clear, prices have already reflected all the good news. Inexperienced investors wait for confirmation, then buy at the peak of collective euphoria. They buy at the top of an emotional wave, only to panic sell at the bottom when volatility strikes. This is a perpetual poverty cycle engineered by the system to extract wealth from the middle class and working people.
Value, perception, and the illusion of control.
Consider a luxury watch in a high-end boutique in Switzerland or Paris. Its value does not lie in the metal or mechanics, it lies in the desire it creates in the mind of the observer. Financial markets operate the same way. Prices are psychological consensus, not objective reality. When FOMO dominates, prices detach completely from intrinsic value. A loss-making startup in Silicon Valley can be valued at billions simply because people fear missing the next technological revolution. At this stage, rational analysis disappears. No one asks, how much profit does this company generate? They only ask, will the price go up tomorrow? This is where the invisible hand of global market makers operates most effectively. They inflate prices with artificial buying pressure and media campaigns that manufacture scarcity. Retail investors, often using leverage, jump in only to be crushed when the trap snaps shut through a sudden sell-off or strategically timed negative news. In investing, price matters less than your position. Price is just a number at a given moment. What matters is where that number sits within a broader trend. Your position includes your entry point, position size, and psychological preparedness. A strong position buying near a bottom or in a consolidation zone allows you to withstand 5-10 drawdowns with calm. A poor position chasing highs due to FOMO can trigger panic after just a 1-2 drop. In short, your position shapes your mindset. A good position enables disciplined decision-making. A bad one amplifies fear and impulsivity.
Envy, the engine of consumption.
Modern capitalism does not run on necessity, it runs on comparison. FOMO in investing is fundamentally a branch of social envy. We cannot tolerate driving an old car while a peer buys a supercar from speculative trading profits. Western capitalism has successfully turned wealth into a measure of personal worth. Missing an investment opportunity can feel more painful than losing money itself. Many would rather lose together with the crowd than watch others get rich without them. Yet the wealth of the crowd during speculative manias often exists only on paper. It is like a game of musical chairs. Music plays, everyone dances, but there are fewer chairs than players. When the music stops, and it always does, reality exposes those left standing. Experienced investors know when to step away while the music is still loud, or avoid the game altogether. They sacrifice cheap excitement to protect their long-term survival.
The debt matrix and the growth imperative.
Why does society pressure us to invest, take risks, and chase bubbles? Because the global financial system is built on debt from the US Federal Reserve to major central banks worldwide. Continuous money printing creates persistent inflationary pressure. Your cash loses value over time, forcing you into financial markets to make your money work. This is not a choice, it is a subtle coercion. If you do nothing, you grow poorer. If you participate, you risk being hunted. FOMO is not just a personal flaw, it is a structural product of a system that demands infinite growth on a finite planet. The biggest beneficiaries are banks and corporations. They need your capital to sustain production and consumption, and they profit from volatility through fees, taxes, and spreads. You are the worker bee collecting nectar, the hive owner reaps the honey. To escape this matrix, you must learn to become a conscious outsider. Missing an opportunity will never bankrupt you. Entering at the wrong time with the wrong mindset will. The wise investor does not fear being left behind, only being swept away by the flood. Market opportunities are like buses. Another one will always come. The key is boarding the right one.
The 72-hour rule.
Whenever you feel an overwhelming urge to buy something out of fear that prices will rise further, step away for 72 hours. Disconnect from news, social media, and investment groups. FOMO is a dopamine-driven reaction, it fades quickly. Remember, money in your hand is still yours. Money thrown into an overheated market may not be.
The contrarian rule.
Markets are most wrong at turning points. When everyone agrees, that consensus is already priced in. If you want different results, think differently. Buy when people are terrified. Sell when they feel invincible. Only about 1% of investors have the discipline to follow this. Ask yourself, am I buying because of value or because others are buying?
The circle of competence.
Never invest in something you cannot explain simply to a 10-year-old. If you don't understand why an asset is rising beyond because others are buying, you are gambling, investing. Keep things simple. Play only in your area of expertise. Focus on a few real opportunities rather than chasing 99 meaningless ones.
Design scarcity and financial power.
In Western financial empires from Wall Street to central banks in London and Frankfurt, scarcity is not natural. It is engineered. Just like a dam operator controls water flow, global financial institutions control capital flows. They create cycles of abundance and scarcity to shape mass psychology. During crises 2008, 2020, they flood the system with cheap money benefiting banks while embedding inflation into everyday life. Then, once the crowd is fully invested at the peak, they tighten monetary policy, triggering crashes that transfer assets from the weak to the powerful. This is not a flaw of the system, it is its core design.
Who really benefits?
Why do asset managers like BlackRock and Vanguard grow wealthier during crises? Because they exploit engineered scarcity. During the US housing crisis, instead of helping families, the system enabled institutional investors to buy up massive amounts of real estate, creating artificial scarcity in homeownership. A generation is now trapped in a rental economy not due to lack of land, but due to concentrated ownership.
Final awakening.
Most of what you fear missing out on is what you never truly needed. The system wants you to believe you must get rich quickly, own certain assets, and keep up with others. But real wealth is not scarce. Skills, health, and trustworthy relationships cannot be manipulated by financial elites. In a crisis, your problem-solving ability is your most valuable asset. Always maintain a cash reserve. When markets crash and panic reigns, cash becomes king. Be the one who can buy when everyone else is forced to sell. True financial freedom is not about having excessive wealth, it is about not being coerced by the system.